For many traders and investors like you and I out there, that move on the markets in the last 24 hours may have seemed bonkers. But in today's video, we explain why a melt up might have been the best thing actually for markets to do. We also need to talk about $200 billion being added on by only 7 companies, 50 of the top S&P 500 stocks having their best day of the year, the NASDAQ performing the best since April, and of course, government shutdown fears being taken away. What does this all lead into? Well, it's a market that is ultra bullish at this stance, but are we approaching where the bears truly sit? Today, we talk about the liquidity traps that could be coming soon, the maximum pain of trillions of dollars of options expiration, and more importantly, why the stats are starting to point towards possible pullbacks over the next week. We'll also be discussing some of the big breakout stars. Tesla, over the last couple of sessions, we've been bullish on this. What a huge move, almost a gap fill. But the star of the show has to be the Russell 2000, a massive move across all small caps, leading into the biggest trade volume that we've seen in quite some time. And more importantly than that, we approach that simply amazing 180 to 181 resistance. So with trillions on the line, yields dropping off, and everything looking great, should now be the time we actually say, let's take another look at these markets and see what's going to happen next. Well, welcome back everyone to The Daily Show, where we talk about markets around the world. If you like macro, lead indicators, hottest charts, or anything to do with markets, make sure to subscribe and smash that like button. We do this every single day together. We've been going strong now for 3 years thanks to people like you. Let's take a look right now at what's happening. It was a sea of green across the board, but there were some interesting sectors. Utilities really performing amazingly because of the expectation now of yields going down. More on that soon, but let's have a look at the CPI number that did this. And it was just basically 0.1 less on the core, 0% across the board. And realistically, it was lowering and the markets just loved it. It doesn't really make sense for it to go up this much though, and for the fact that the market was so aggressive. It was more because it was squeezing so many bears out. And unfortunately, many bears out there would have been getting crushed over the last 24 hours. I'm sure that has happened to some of you out there, and it's really scary and obviously quite upsetting when you get put in those positions. This is probably the reason why I think a lot of this happened. Equity put call ratio was showing us that we had way too many puts in the system, and Wall Street certainly wanted to crush those positions, pushing it higher. We've seen similar occurrences to this, and we posted it over on our Twitter X account. So if you're interested in taking a look at all of those things, make sure to jump on over, and links in the description down below, along with our new newsletter for VIPs. Early access is in there, totally free. And of course, I suggest you go and sign up for that. It's in the same link. Let's have a look at bullish percent index. We saw a huge rise up in this. We're waiting to see whether it can get above 70 to really tell us we've probably got a new all-time high coming in. But for now, very strong movements, and it's kind of showing you that pullbacks are probably going to be met by bull demand, which I'm sure most of you are aware of considering these moves so far. This is where the stat comes in though, 7, 8, and 9 days. We've shared this one before quite a few times. Since 1950, when you had such huge rallies up, you might be thinking, wow, pullback's coming. Unfortunately, the stats were against that. The stats were actually ready for a melt up, and it wasn't really a melt up. It was more of an extreme parabolic move all the way to the next level, which is that 45-12 zone. And we'll talk more about that later on. Another reason that you may have guessed why this could occur had to do with the bull-bear positions in leverage retail opens. Basically, we had 61% of people bearish on leverage positions, 39% bullish. The FTSE was the only one with the bullish position. Guess what? Didn't do very well. And then, of course, the Dow was 70% bearish, 30% bullish, and it goes on and on and on. I posted this over on our X account as well if you're interested. So what's happening? Well, the Russell had the standout day. 5+%, that's huge. And of course, it's going into an interesting period for it because somewhere around this November into December, January period, we do tend to see a bottoming of Russell that usually comes in with a very nice gain through that January into February effect. This is the one that many people will start to talk about and start to focus on. And did we just see activation of the Russell for the next couple of months? It's very possible we did see that because we already know we had a great read on the 2000 cycling from the 52-week low. We shared this now, I think almost 2 weeks ago, maybe a week and a half ago, and it showed that over the next 1 month, all the way up to 12 months, the Russell was mostly sledged to outperform the S&P 500 and the NASDAQ, 25.6% average return with a 100% track record. And it wasn't like we had just a few data stats for this. We had quite a lot. Now, of course, that's a long time away. And for traders, they're going to say, wow, that's too far away for me. But it does show you that there's possibly a change here that's occurring underneath. We also posted some stuff on Maximum Pain over on our X account, which we'll go through soon. But let's discuss probably the biggest elephant in the room. You're probably saying, well, how could we be going so bullish when everybody turned bullish on sentiment surveys last week? Yeah, everyone turned bullish, but it seems like the reality is they weren't actually going bullish. They were buying puts. And that's a little bit of a concern. And that's why we actually managed to get up to these levels. 50% though bearish into 42.6% bullish. I'd be very interested to see how this week's data comes through. Will the sentiment report really show that? Here's one that really was timely for the last video, which was us talking about corporate insider sells on utilities dropping to the point where usually you expect a bit of a bounce. They had a plus 4%, which is a lot for utility sector over the last 24 hours. So obviously those insiders getting a little bit of a knowledge on what was maybe going to happen next. Before we go through some dark pool transactions that happen, some big ones, share of investors who say they're bullish about stock markets, just be concerned if this continues to hold up, because as we know, often when we do get these strong reads for a period of time, there is a pullback coming. And that's something we will be looking at on the channel together very, very soon. Here's another one that I thought was interesting, which was basically all of the investors piling into treasuries. And you might think, well, that's why I don't want to buy treasuries right now. Well, actually, when we reach these similar points, such as March 2009, November, and even other serious points where we've seen these over investment in treasuries actually haven't performed super badly after this. So it's something that we will be looking at. And of course, I'm actually expecting treasuries may have just bottomed based on the previous structure that we've seen in markets at this stage. We've been talking about that for a little while. We also know that bond yields usually anticipate a Fed cut coming, 2 months, 4 months, 3-month leads. Sometimes they're right on the dot. If we do keep seeing the US 10-year, 20-year, and 30-year drop off, and we've already seen what we call a first time frame change of trend, or one of the first closes that shows us that it might be over for the rate hikes coming through, then yeah, it could be very soon when we see the Fed actually go for the rate cut. It may be actually Q1 of 2024, which is, of course, my random estimation, which means absolutely nothing, just like all of our other guesses that were in there. Some of you thought you were with Goldman Sachs end of next year. Some of you were Q2, some were Q1, some were Q3. At the end of the day, guessing when the rate cut comes, that's not really going to help us that much. What we're interested in is what does it mean if they do a rate cut? Well, generally, if the Fed rate cuts, something bad happens. So remember, if the Fed rate cuts, something broke, and they're trying to support the companies and the country. Generally speaking, they don't do it out of their goodness of their heart. In fact, when they went from a previous hike cycle to a cut cycle, we actually saw markets go down on average quite a lot, 23.5% and 195 days average to the low. Now, I'm not saying it's going to be this bad. I don't know that. Neither do you. It may be worse. It may be better. It could be like 1980 where it never even went down. But what we're trying to say here is that we don't really necessarily need to be concerned before it happens. It's the concern after. And that's what we've been getting through recently when we've been going through the statistics and the general play that happens through the end of this year, which is, of course, usually a rally that may stop early in 2024. Let's go through gold. This one was really finding some big drivers towards the upward side. We also saw gold with a squeeze on it the other day. Same stats we've been putting in every video, so I won't talk about that too much. Here's another interesting one that shows you when we've seen similar times where we've had basically a market that was bullish throughout the year, which 2023 has been. Then usually November 15th to December 31 was positive, and we actually had 27-3 in terms of the bullish times through that. A pretty good stat if you are a bull. 30-year bond yield performance between November 6 and 26 was usually negative, which of course was helping treasuries. So far, so good for that. An interesting stat that happens, well, pretty much every single year. Let's go over here to November. What's going on with market performance at this stage? It's been a little bit better than this year. Of course, you're going to say, well, it's only 1% here, but we've done a lot more than that. So I would say it kind of looks like this at this stage. Now, if it's going to pull back, when does it tend to do so? The bigger pullback usually happens the week after the OPEX. So the OPEX is the trillions of dollars of options expiration. That's happening this Friday. Then we would usually see a bit of weakness coming through the next week. Then we would see strength. Will we get the pullback then? The markets are starting to signal that that's a real possibility, and obviously we'll need to look for structure very, very soon. Let's move through some of the dark pool or big transactions. We had some inverse gold, big trade coming through. Obviously, gold was really doing well last 24 hours. It absolutely smashed it, which was pretty sweet. And we saw also gold miners finding some larger investment sizes. So you can see here, recently gold miners have had quite a lot of large trades come through out of nowhere. It's any of the gold stocks have had quite a lot of big dark pool buying or big dark pool positioning. This is another one we showed, which was the dollar having a massive position in it out of nowhere. We kind of theorized that maybe the dollar was weakening on the charts. And it certainly got helped by CPI. The market set up, the market showed the structure, but really the CPI did the damage on that one. It was just all of it was kind of like coiling for these particular moves. And it turns out that they were quite large. Let's go over to average options volumes and what was happening here. Well, of course, every single one of these stocks was green. However, the trades that really made a big difference here is, have a look at this. 57% of the session was calls, 43% puts. So obviously the puts are dying off as we move up to this big critical level. 47.2 million volume compared to 39.7. So that's a huge, huge average day. This is way above any average day that we usually see. And there were big moves across the board. The Russell 2000 getting a lot of activity on it, of course. But more importantly than that, we saw activity across so many different stocks. And you'll notice here all the unusual volumes coming through and some of these big ones. Tesla doing a 1.18, having 1.5 million call volume to put volume. And we also had some big trades coming through, things like the Microsoft and even, the Qs and everything else. So yeah, check it out. Pause this screen if you're interested. I think solar was probably the most interesting one. Enphase in particular, what a chart that ended up being. I had that in our Market Masters Club and I was talking about it and I was like, yeah, I'm going to set an alert for this. But unfortunately for me being Australian, by the time the market opened, it was about 1 something a.m. and the trigger went off a little bit late for me. So that was a crazy day. It went up like 15% or something on the session. Let's move over here to rotation. What goes on was solar, 10% up across all of TAN. Clean energy doing very well. KRE, regional banks coming back strong. Look at home builders. Wow, that's a strong read for those. We also had some of my favorites at the moment, metals, iron ore having a great session, gold having a great session, utilities having a great session. I mean, if you wanted to say what was doing well, it was a lot of the semi-underloved things that retail don't tend to be in as much, except for the hyper-growth stocks. They were certainly going crazy. But semiconductors only did 3 in comparison to everything else. Notice the defensives down here and also energy having a pretty bad session. It doesn't really like, of course, a slowing inflation read, and that's what we saw there. Let's move over to some others that have been happening the last 5 days. Notably, I think IBB Biotechs, which should really do quite a lot better off a lowering interest rate. That was actually the worst performing of the major sectors over the last 5 days. Could there be opportunity there? Certainly worthwhile considering on a chart in terms of whether we're getting some structure there. We also see semiconductors and home builders up in the top. And now in 1 day, TAN went from like one of the worst to one of the best, up 4.83%. It was just massive across the board. Let's jump into the charts now and have a look at the advanced decline and, of course, the key levels we should be watching. First up, advanced decline was massive, 2309. So we saw a huge read, big high. This is an outlier kind of in terms of advances. Here are some of the similar reads we've had November of 2022. And we also got a read back here in May of 2022. We haven't seen such a strong read for a while, though. So this is pretty serious for thrust, for breadth, all of those types of things. No change on our orange indicator that we're talking about in terms of effective yield. So that means even though it dropped down here a little bit, which is fine for the move. So overall, no early warning signs there. And PCC dropped right back down. So rather than having a decent amount of puts in the system, we dropped into the call side, which usually means that we need to start thinking about, question mark, are we at a key resistance? Do we see structural change? Are we ready for a pullback? We're probably getting extended at this stage. Well, it's probably not even probably. We are getting extended at this stage. In terms of the percentage of stocks above the 20 moving average, it was a huge session, going up to 76% of all stocks. Just to show you that above 200, that is absolutely done a V shape, showing that this is more than likely a real recovery. Of course, we saw